We'll have to cross over to the Labadi Beach Hotel, where graphic business meeting is being convened, and Mama Vio Swabwaje is there with the latest. Now let's go over to Mama Vio Swabwaje.
Deposit-taking institution, and many a time this occurs, and when it occurs, then people tend to fall on government and the central bank to bail them out. But is it the right way to go? Is there a responsibility on the part of you, the depositor, to be careful of where you deposit your money? So the Bank of Ghana in 2016 managed to get the deposit insurance at pass. And I believe that this year we would really want to implement it. And we believe that the discussion has not really taken place. So we decided to make this day the day that we can really have a proper...
To begin to have that conversation.
Very good, very good, very good. So that is why we are here this morning.
And Marco, how important is this deposit insurance to your bank, for instance?
It's very important to my bank, but even primarily to the good people of this country, to every citizen of Ghana, because the whole essence is to encourage people to be comfortable and confident in our financial institutions so that they can deposit money with assurance that there are adequate safety nets to take care of them in the event of any eventuality. Should anything occur, we have the necessary processes, we have the right framework and structure to ensure that they are adequately protected. And the question then is, what's the best way of doing this? That's the reason why the Act was passed. It's now law. We get into the stage where it's going to be implemented. Now, this discussion should then facilitate our understanding of the implementation mechanism, and then we can also together as a collective see if it's adequate, if we need other interventions, and what will be the best combination to ensure that the good people of this country are very comfortable, they are very confident in their financial institutions, and when things go pear-shaped, there are adequate protective measures in place to take care of them.
So who do we expect to meet later this morning?
As you can see, I mean, we have the collection of the brightest and best in the financial industry.
You've got some of your rivals here as well.
Actually, they are competition, but they also complement. It's the pieces that come together to make a very robust financial system. And so we need talent like them, and we are very glad to have them as competition. But you see that on this occasion, it's more of a collaborative effort, and that speaks to the bright future of the financial services sector in Ghana.
Theophilus, you want to add to the people that will be meeting here, who will be having the conversations, and how do we contribute? How is people who are watching us right now, how do they also become a part of the conversation that will happen here?
We'll be privileged to have the governor of the Bank of Ghana to speak to us. Then also he would give us the rationale behind the act. Then we also have the Mr. Setasanti, who is a lawyer and who is specialized in the financial services sector. He would also speak on it. Then we have Nanotua Champon, who will also talk about the governance of the whole scheme, because a company will be set up to administer the fund. So he will also speak about it. Then also we have, like Malco said, we have the fineness of the brains in the financial services industry here. I mean, CEOs of the banks are here and top executives are here, and they will all contribute to the discussion. So that is basically, that's what's going to happen. For those who want to join, as we go along, we'll announce the WhatsApp line and the Facebook, and we're on Twitter, so we'll be taking questions from them. And so it's not just about those in the confines of this confines of this auditorium, but rather those out there too will be part of the discussion.
Sure. Yeah. So the last time we talked agric, we're talking insurance. I wonder what we'll be talking about next.
Watch this. What you can be assured of is it's going to be a subject which is pertinent, which is very important, which is very relevant. And typically we pick up on issues that are so very dear, but may have been slipping off our radar. We try to bring it up. We try to get the entire nation to refocus and ensure that out of our deliberations, there are very concrete takeaways that we can use to improve the quality of lives of our people.
All right. We're going to be interrogating further this act because a man who contributed to it, our former Finance Minister, Seth Terkper, will join us. So I'm just going to let you go. After all, we said the first hour was going to be breakfast.
Yes.
So go and have some breakfast. Get ready for the main conversation.
Thank you.
Thank you for joining us here on the AM show. Thank you so
you
much.
for the privilege.
That's Theophilus Siate and also Mauko Afagino. We're still here at the Omanya Hall. This is the Labadi Beach Hotel. If you've just tuned in, well, you've missed a lot, but not quite, because the main conversation is yet to come, and we'll bring you that live right here on JoyNews. When we come back, former Finance Minister Seth Terkper will join me. Stay with us.
And please know that it is the graphic business meeting. It's a breakfast meeting, and so it means that you're going to have a setting of people having great discussions and also a topic being delivered by a speaker. But notably, you're going to have also additional scenes of people taking some food. But that's the atmosphere as it is. But just in case you don't know, you can always join us on Facebook, JoyNews on TV, and also we have our interactive handle on Twitter, JoyNews on TV, and you can watch this live through our channel on YouTube, My Joy Online TV. We also have to take a break. When we come back, we'll have a lot more for you on the show. Don't stay on.
Conversations ahead of the main conversation that will be had later today at the main hall is the graphic business Stanbic Bank breakfast meeting. And the theme for today's conversation is deposit insurance, a catalyst for stronger banking industry. Joining me is a former Finance Minister, Seth Terkper. Good morning to you, sir. Yeah, I wonder what you've been up to these days.
Well, I started life in the public service, went into consulting for almost 12 years. So at the moment, I'm working to get back to do some consulting. I also do some teaching, not regularly.
In Ghana?
Yes, I do not regular as I used to do in the past, but occasionally I do by invitation. So Gimpa, Legon, you know, those are the two places where I've gone so far.
So by this, if people want to have you give a lecture sometime, they can extend an invitation to you, right?
Oh, I have some invitations, you know, to participate in some of these things, but I'm in listening mode at the moment. I come to sessions like what we are going to have today, which I think is very important. I have been on panels, and I've, you know, since leaving office, been patronizing the breakfast session, and it's something which I would encourage people who have the time to come in, because it's very intense conversation, very professional, and I'm glad that, you know, it gets appropriate coverage so that those who are not able to be here, you know, maybe we can consider, I don't know, it's been done, streaming, so that people can concurrently be looking. These days on Facebook and others.
Yeah, so we're streaming live on Facebook on JoyNews.
So that's very important.
But we're glad to have you on our show.
Yes, thank you very much. Yes.
So let's talk around the theme, deposit insurance, a catalyst for stronger banking industry. Some have said that this law really was because of what happened with DKM. But you say not exactly.
Well, DKM is certainly a lesson for all of us, but we must be reminded that the banking sector can be delicate, and often the influences are beyond just the core banking sector. Before DKM, we had a non-performing assets recovery trust many, many years back, you know, when the banking sector was very heavy with debt. And then we had BCCI, those who will remember, BCCI, Bank for Commerce and Industry, which collapsed globally and had an impact, you know, in Ghana. Those are the two big, you know, episodes. But we should also not forget that when we are talking about the stability of the bank, we can think about ESLA, the energy sector levy, even though for the energy sector, it ended up saving, reducing the heavy SOE debt on the banking sector. I think more recently, you can also think about UT Bank and Capital Bank. If commercial bank and the government had not, stepped in, immediately, what would happen is people would lose their deposits. And that's where confidence in the banking system is very important. So this is where the insurance comes in. Like everything insurance is for a rainy day. When things are normal, you don't, we are told that it's when things are normal that you should think about insurance. So that when that, rainy day comes and it's damp, then you can fall on that. We can talk about it. So in terms of the stabilization of the bank, yes. And I think there is the perception that the law came as a result of DKM. No. The law actually came as part of the revision of the Banking Act.
Okay.
And the depository, laws that were passed. So it was something which the governors at the time were spearheading, and the Ministry of Finance, as a macro institution, but also as the minister who tables their laws, who were deeply, involved both as a macro issue. So there was an overlap, a coincidence that occurred. I stand for correction, but I don't even think the law as it is now backs microfinance companies yet. And I think that is an extension that has to be done, which is part of the DKM experience. But what it simply means is, and I'm sure your audience may have been told already, is in the event that a bank collapses, the insurance kicks in.
But it's not 100% cover, is it?
Yes, there's a minimum. It depends. For small savers who are normally losing a lot, it could be 100%. Because if all I can put in, save, because of my low income, you say 5,000 Ghana cedis or 6,000 Ghana cedis, and the threshold is, let's say, 10,000, then it means I'm fully covered. For those who save beyond, then they have to look, businesses, for example, they take their own insurance against some of these things, yes. So it's relative. There's a threshold. The traditional way in which it operates is there's a threshold, and then when the event occurs, you are short of that. And so normally it covers low-income people, remember, who would have had them. Even though their sums may be small, they are the ones who would also have the maximum impact. Yeah.
Okay. But how is it different from the traditional insurance that we know? Is government, for instance, as at the time that this law was being cooked, was there a point where government was supposed to contribute an amount of money to this?
Yeah, I think let's go back again and look at what happens in economies, and which is what happens in Ghana. You don't want your banks to fail. And so ultimately, when banks fail, and when they fail in a big way, like even the big ones that nearly collapsed in the US, and some did actually collapse, usually it's beyond even the central bank, to save the situation. So it comes down to a fiscal tool, to save the situation. And if it continues to deteriorate, then it's a taxpayer. Because otherwise the whole edifice, financial edifice because it just keeps, rolling on. And so that's what you want to prevent. And so, yes, there's a government role. There's a serious government role in this, because government, as the one that takes the ultimate risk when things go badly wrong, sometimes even private sector things go wrong, you don't want to, you want to provide as much aid as possible. If you have a big employer, a case in point is Ashanti Gold, Anglo Gold, and the things that are happening, we know it's impacting, livelihoods, and others. When gold prices go down, when cocoa prices go down, farmers take a hit because they don't get the annual increase. So ultimately, it is about governance, it's about government, and it's about the welfare of the people. So that's what you want to prevent. So yes, government has a role to play upfront, in preventing that kind of
What's
situation.
the commitments? I read about 10 million. Was that a 10 million Ghana cedis?
Yeah, that could be the seed element. And I think the details will be provided. But the seed element, and it varies, but there's a contributory element,
From the individual?
From the individual.
How is that?
insurance as well.
Except that this is compulsory insurance.
I wouldn't want to look at it that way, because with hindsight, I believe, and as I said, the central bank, the governor, the central bank, the Ministry of Finance, government came in the UT and the capital bank situation, for example. But what if, some believe that let them fail and let the private, shareholders. But we know that the shareholders, their money is gone anyway because it's negative, right? So with hindsight, if you were going to go into that situation and somebody told you take an insurance in the event that this should happen, you would definitely have taken an insurance even as an individual. And that's the way, as I said, it's when a failure occurs, which happens, we don't want it to occur, but it's like a lorry accident, it's like fire or anything you want to,
So do you know what has, if you like, prevented us from using this law? It was passed back in 2016.
I think what is left, and again, the details, I've been out of office for some time, so I don't want to pretend that I know the current state. But at the time we were leaving, the law had just been passed, and there was a need to operationalize it. And the initial funding has to come, for the takeoff. So I believe they probably have moved beyond that stage now. I am not, and that's why I'm also here.
Yeah. For us to know what the update is. But is it, from what you saw since leaving office, does that answer every question? I mean, is it the solution?
Yes. I mean, the point is, this is non-partisan. Let's be clear. This has nothing to do with the color of a government.
Sure.
This has something to do with savings. Those who save. And when it comes to savings across the political divide, everybody is saving, and we encourage everybody to save, because the more we save, the more loanable funds, because it's from the savings that the banks, give our loans, and that is where the catch comes in. The funds must be managed well. If I save, and you come and take it as a loan, then you must pay. Otherwise, then the bank, first a single bank, then the edifice, if there's a rush on the bank, so it's not a partisan issue at all. And let's also remember that below the government or the partisanship, there's a huge public service, who normally are involved, with the nitty-gritty, of this. So, and he gets his briefing. So I believe that if you allow for the transition, and when with a year gone, I'm sure things are gaining some momentum, which is probably why it's very important that we know from today what the status is.
I wonder if people would take this positively, if you have to pay a little amount as insurance alongside what you're depositing. Remember the 17.5 tax and all the noise that was made?
Well, let's separate taxes and imposition. As far as insurance is concerned, it's often voluntary, right? Even if you are dealing with a state insurance institution like state insurance. Okay, let me correct myself. The state has to come in, because sometimes when you are reckless, say in the motor vehicle accidents, for example, when you are reckless, you may affect somebody's vehicle. And so third party, you may injure somebody. So third party insurance is compulsory, right? So certain elements of these things have to be compulsory. But beyond that, other elements too. So you can take it that the compulsory element, back to where we started. If there's a little contribution that you have to make, that may be the compulsory element. The institutions and others contributing, so that we are all protected up to a certain, limit. I mean, even the rich losing all his money, that limit at that point in time. So I think that's the way we have to. And I may want to join the appeal in saying that we shouldn't look at this as, a form of tax or an imposition. This is a protection, which, in the event of the incident occurring, comes to, benefit you as an individual. Yeah. Because remember, it may happen when the government position itself may not be solid. As we speak now, the FPSO has been shut, and that means that export revenues are going to fall, and it happened since 2015. So I'm glad that hopefully we are going to get a resolution to this thing. So when it happens, when the bank collapses, at the time the government is so strong, You know, even if the government comes in, then the government is going to borrow, and then we all complain about debt. You know, so you know these things all have, you know, the effect is like a roll-on. You know, so that's what you want to prevent. Otherwise, then it affects everything.
You know, there was a bit of uncertainty after the collapse of UT Bank and Capital, and there were rumors that 7 more banks were also going, if you like, retired from main government business now. You've been sitting back. How would you say, if you were to analyze the banking system that we have today?
I always have an interest in public service, because that's all my career has been public service. I started as a public servant or civil servant, if you like, as a tax official, you know, and by grace of God reached what one would regard as one of the pinnacles of, you know, public service. So when you have been through this, and even when you have only had a chance to serve as a politician, you can't retire from observing what is going on.
So you've been doing a lot of observation these days. Is there still some kind of panic in the system?
No, I think that we should take what the governors, you know, say, and what, I mean, the area which we started resolving, including the ESLA, was non-performing loans and their impact, you know, on but that was, ESLA itself was one of the measures to stop, you know, and then to bring the state-owned enterprises, and remember there are energy SOEs who are the ones who are also going to participate in the oil and gas, you know, sector, which will strengthen the economy. So I think that, you know, it's very important that, you know, we are, you know, banking is about confidence. So if these rumors are going around and you begin to express reservations, that itself undermines that confidence. You know, so I think the Bank of Ghana is one of the best institutions on the continent, and I have every belief that, you know, the public servants and the governors who are very experienced, you know, after there are 2 governors now, I don't know about the third, but who have been Bank of Ghana products themselves. You know, so we can be sure that they have been through the nitty-gritty.
Definitely. Finally, before I let you go, what are your expectations to today's events?
No, as I said, it's very welcome to get an update, to know where we are. So, you mean in terms of the current events, I think it's a welcome contribution to the development of the economy, because it's a very important aspect of the development of the economy. And I think it's important, and it's good to commend, you know, from the organizers, graphic business and their partners, Stanbic and co, you know, to the high level of participation. I happen to know the panel. I happen to know Mr. Asante very well, you know, among the best in the private sector. Governor himself is making time to come. So I think it shows the seriousness that is attached to this. You know, and
finally, where do we find you?
I'm using the same number. So.
Thank you so much for your time, sir. Yes. We wish you well. That's former Finance Minister Seth Terkper joining us for a conversation. We'll bring you more conversations, and the main conversation, of course, on the theme Deposit Insurance, a Catalyst for Stronger Banking Industry, will be live here on JoyNews. We're also streaming live on Facebook. So stay with us. All those watching from across, we'll bring you a lot more. Stay with us. We're coming to you live from the Omanya Hall. This is the Labadi Beach Hotel, and you've been watching the AM show. Today, we have special programming because we're bringing to you live the Stanbic Bank, Graphic Business Stanbic Bank breakfast meeting. And the main conversation is on deposit insurance. My next guest is the Chief Executive Officer of Stanbic Bank, Mr. Al-Hassan Andadi. Good morning.
Good morning.
And good to see you. The last time we spoke at Greek.
Yes.
Exactly. I know that the banks are venturing into insurance in various ways, and I wonder how this particular insurance that we're going to be talking about today is different. How is it different from what we already know?
What you know is we will get into insurance as another line of business to make money out of it. But this one is about telling our depositors that the regulator asking us to insure our depositors. Deposits is the stock of trade of banks. So if we insure our properties and insure our people, why don't we insure the stock of trade, which is the deposits which other people have come to give to us? So it is actually a cost to the bank, not a revenue line. But it's important that we have that. Yeah.
And this new act, this law that we're hoping that it will come to force, would see us as ordinary depositors being pushed to pay some extra money as cushion. Correct?
No. The deposit insurance will be paid by your bank. So basically, this deposit insurance is to tell depositors that, look, this money you've left with this licensed institution is not risk-free. So for me, the critical part of deposit insurance is to let the depositor know that the institution you've left this deposit with is not guarantee you 100% of that deposit. It's important, and therefore we have what we call the risk-reward trade-off. So it's really, if you look at it, it really just guarantees you a minimum payout if the bank or deposit taking institution goes down. However, it's supposed to actually now, from day one, let you understand that you're taking a risk. You're taking a risk by placing your deposit with this myriad of deposit-taking insurance, deposit-taking institutions.
So Stanbic is my bank. You will not ask me to pay anything extra?
No, we will not ask you to pay anything extra at all. It is us now taking the whole pool of deposits that we have and applying the right formula to it and pay the deposit insurance for the deposits that we hold. We're not asking our depositor to pay anything for it.
Should anything happen, God forbid, do I get 100% what I put in there?
No.
Why not?
So that is where, for me, that's really where the message is. It's just to tell you that deposit, and the regulator, in this case the central bank, is telling you that, and you have to stretch it back to the previous failures where everybody has gone to government or central bank to pay them. It's because we were not told. We're not told that, you're taking a risk. If you're taking a risk, then you'll be very careful where you go to place your money. So it's about caveat emptor. Let the buyer beware, of the kind of risk you are taking.
Yeah. Okay.
Yes.
Just your thoughts. We've got amazing speakers today.
Yes.
Dr. Ernest Addison, the Governor of the Bank of Ghana, Nano Tuo Echampo, banking consultant, head of Osei Center for Executive Education and Research. And then we've also got Seth Asante, who's a partner at Benti Enshil Lechen and Kuma, and head of financial institutions and capital markets practice group. What are you hoping that these gentlemen would bring so that the people who are watching us, the people who are following us via social media, and those who are here in this hall who participate would get it? I mean, what are you hoping would come out of this?
Well, I mean, the graphic business Stanbic platform that we've created for us is to be in the forefront of top leadership. So the speakers that you've highlighted, I mean, nobody could speak about deposit insurance better than the governor himself. And he's coming with a large retinue of people. And of course, it's a law. So the questions you ask as to who will take the cost, I hope Seth Asante will deal with that. And Otuo Champong is for the client, So Otuo Champong, we expect him to come out with all the issues that will be on the minds of our depositors. So I think we have put together what I would say the very best of resources to be able to deal with this subject very well.
How far do you want this conversation to go?
Well, as far as our Ghanaians understand the importance of deposit insurance, if at least it highlights the fact that there's a gap, there's a difference between your deposit-taking institutions. So the risk reward, if you have somebody who is paying you, let's say 60% per month on deposit, somebody's paying you 10% per month on deposit, all in there should tell you somebody's taking higher risk and may lose you all your money. Somebody's taking lower risk and your money will be available. So in between, we expect people to make rational decisions. It's all about people making rational decisions. Don't just go leave your money with a deposit-taking institution and expect to come and get it. Or when you don't get it, you go to a regulator and say, pay me back my money. No, you took a risk. You took a risk by placing the deposit and taking the interest for it. and you chose the highest risk. So if you lose it, it's your choice. So for me, if this conference achieves nothing, it should sow in the minds of people that you take a risk when you take your deposit to a deposit-taking institution.
Is the banking industry ready for this law?
We're absolutely ready. We've been kind of discussing it for the last 2-3 years. So we're ready. We're ready.
Okay. All right. We'll leave the conversation here. We will catch up. But you're not speaking. You're not speaking
yes,
today.
I'm not speaking. I don't want to self-serve.
All right. Yeah. What's the next plan after today's events?
After today's event, I'm sure the media will carry the message. We would work with the media to make sure we carry it in a manner that can be digested by every client in every category. So I'm sure we will continue to engage you in various small presentations, so that this message is carried as far as it can go, and then becomes the law of the land.
All right.
The active law of the land. Yes.
Thank you, sir. As always, good to have you.
Thank you very much.
And that will be it, at least for us for now. I'm taking you in the main hall where the conversation proper would begin. And my colleague Evans Mensah is the moderator for this function. So enjoy it and make sure you fully participate.
Summit, especially for our resource people who are going to deliver deposit insurance catalyst for a stronger banking industry. Father, we believe that even as you touch their hearts and this message resonates with everybody gathered here, as well as all the Ghanaian community and the global industry, Father, we believe and we have that affection that they will articulate it well. And this thing will resonate very well, so that all and sundry will accept that indeed, God, you are strong, you are El Shaddai, and you are Jehovah Nissi. But Father, above all, we are persuaded that neither death, nor life, nor angels, nor demons, nor principalities, neither height, nor depth, nor any other creature will separate us from the love of God, which is in Christ Jesus our Lord. And Father, we believe that everything that will be said here will galvanize our economy, and Ghana's economy will be an oasis for all and sundry to accept that indeed we have arrived. This is what we ask in the name of our Father, the Son, and the Holy Spirit. In Jesus' name we will pray with thanksgiving. Say amen. Thank you very much, Mr. Tego. Again, this morning we are live on Joy 99.7 FM. We're also live on the JoyNews channel on Multi TV. We're live on the many social media handles, on Graphic, also on Joy, on Facebook. You can join us on Twitter as well. I want to start with a formal welcome. And I will now invite Mr. Ransford Tete, who is the acting MD of the Graphic Group, to formally welcome us and essentially tell us why we're here. A round of applause, ladies and gentlemen, for Mr. Ransford Tete.
You addressed me appropriately. I'm Nana Kwekude Nkoswahini of Pakro in the Eastern region now. Evans, for your information, thank you very much. Good morning, distinguished participants and experts. I'm referring to the speakers for this breakfast meeting. Once again, I warmly welcome you. With a warm heart to this edition of Graphic Business Stanbic Bank Breakfast Meeting, the first in 2018. This meeting is a platform the Graphic Business deliberately created for the business community to share views on crucial issues relating to the well-being of the economy. Therefore, at this meeting, we choose for discussion one important business topic that has implications for the development of the economy. Graphic business believes it must always live up to the expectation by creating quality content to help business community to plan, not only through its pages, but also platforms such as this. For us, quality is our guiding principle. Thankfully, we found a partner in Stanbic Bank Ghana Limited, a bank similarly known for quality services. Together, we have chosen the topic for today's discussion, which is deposit insurance, a catalyst for a stronger banking industry. Our moderator, in his opening remarks, said that the topic may look very technical, but it has implications for farmers in my village, tomato sellers in the market, and everybody. Therefore, we believe this topic is appropriate now, and the reasons are not difficult to find. Recently, we have had some banks and financial institutions go under the water, with the result that in some cases, customers lost deposits. I'm referring here to the microfinance institutions. Even as I speak, the Achimansa Rural Bank at Achima Yiribi in the Achimansa district in the Eastern region had locked its offices, and customers, mostly small-scale and peasant farmers, do not know whether they are going to get their deposits. Many reasons, including poor corporate governance, bad investment decisions, and sometimes outright misuse of depositors' funds, are assigned for collapse of banks and financial institutions. Whatever the reasons, though, depositors don't expect to lose their deposits. To grant security to depositors, Parliament has passed the Deposit Protection Law to secure the funds of depositors, but it remains largely unknown among the people. This meeting is meant to shed light on this important law, to generate more informed discussion of it and create awareness among the general population. On this note, I want to make a special appeal to media practitioners in the country, particularly those covering Parliament, to take particular interest in the laws that are passed by Parliament. In that way, they may be helping to educate the people about the laws that are passed, the laws that touch the very lives of the people in this country. If you step out, or even in this room now, you want to ask about the Deposit Protection Law, there may be just a few people who have ideas about this most important law. This meeting, therefore, is meant to shed light on this important law, as I said earlier. Such awareness is important because the banking industry could suffer lack of customer confidence among the population, which may lead to low deposit mobilization if potential depositors feel that they may lose their funds in the event of failure of a bank or financial institution where they keep their funds. It may also interest all of us that bank collapse has been with us for several decades now. We can recall the Bank for Housing and Construction, National Savings and Credit Bank, the Cooperative Bank, recently the Capital Bank, and the UT Bank. Certainly, these events could hurt the economy, given that banks help aggregate small amounts in individual hands for application for productive use. Already, the country has quite a sizable population keeping their money outside the banking system. Apart from the awareness, we also learned what really is in the law for bank customers and the banks themselves. Does the law really give comfort to the customers and the banks? For this education, we have a highly qualified panel with the right knowledge to lead in the discussion. I'm optimistic that they will help to make the meeting a very, very useful one. Ladies and gentlemen, once again, you are welcome to the graphic business Stanbic Bank breakfast meeting. Thank you for coming. Have a very useful deliberation. Thank you very much.
Ladies and gentlemen, I already have one ram. I don't want to add a second one, so please add a bigger round of applause for Nana Kweku Day, the first. Nana, thank you very much for sparing me the sacrifice of a ram. I want to acknowledge graphic business in partnership with Stanbic. Without them, this wouldn't have been possible. Also, the partnership has been very good with Joy Business and JoyNews. And I'm pretty sure you probably have noticed the smartly dressed gentlemen in black suit and tie. They are from the Protocol Service Prosline Events. And also we want to say a big thank you to IVET for support with digital registration. So we're going to go into the main event. But before we do that, we've heard from Graphic. We need to hear from Stanbic. Ladies and gentlemen, with another round of applause, let's welcome MD of Stanbic Bank, Ahasan and Danny.
Distinguished panelists, the Governor of the Central Bank, and thank you very much for coming. Our invited guests, my colleague CEOs from the other banks, Dansaki, Patience, and all the others, thank you very much for coming. For us, the platform that we've created with Graphic Business is a very important platform for us. We want it to be the forerunner for thought leadership on most topical issues. And it's our view now that the most important subject impacting the financial services industry is the deposit insurance law, which would be activated. And my personal view is that this is long overdue, long overdue, because banks insure buildings, machines, and everything to protect themselves. Deposits are stock in trade, which people trust us and bring to us. It's only appropriate that these deposits are insured. And the other element for me is to let anything that has insurance tells you it has risk. And therefore, if you go and leave your deposits with any deposit-taking institution, please be aware of the risk. I'm sure the speakers will tell you the limits to which you are insured when there's a failure. And hopefully, when these things happen, and we don't want it to be frequent, nobody will go into a central bank or the government to pay them for monies that they've left with various deposit-taking institutions. So it's basically an awareness that please balance your risk rewards. For those that pay exorbitant interest, they probably are in a risk category that you must be aware of. For those that pay lower interest, they probably are in a risk category that you're aware of. And therefore, the possibility of losing your deposits sits in that space. So we think that this is a timely intervention. We couldn't have gotten a better panel than we have put together today. And we also hope that I see captains of industry here, that we will carry this conversation beyond today and ensure that the real intent of the law is carried to the letter. On this note, I don't want to stand between you and our distinguished speakers. I want to once again thank Graphic and Nana. I don't want to slaughter Ram either, for this partnership which we have thoroughly enjoyed, and also all of my colleagues and the distinguished invited guests who've come. let us carry this message, and I think I want to reiterate what Nana said. The media houses must be very circumspect when we come to reporting and or analyzing these important subjects. Again, it should not necessarily increase, deposit insurance should not necessarily increase your cost of doing business with the bank. It is a cost that the banks will absorb, and it's only appropriate we do that. As I said, we insure our own buildings, which we don't pass on to you. So on this note, I want to thank my Nana and my friends at Graphic, and to wish you all a very happy morning, and very informative and discussions, and so that we can make the financial services in Ghana a much better place. Thank you very much.
Mr. Hassan and Danny, for that welcome from Stanbic Bank. We're now going to our main discussion, and as you already have heard a lot about this Deposit Protection Act that was passed 2016, it sounded pretty technical then, and it went under the radar. As a journalist myself, just preparing for this event, it's the first time I ever thought about the act that was passed somewhere in October 2016. And so I'm grateful that we have the people here who understand what this law is about. And that is why I want you all to join me with a standing ovation, a round of applause, and let's welcome Dr. Ernest Adesing, who is the governor of the Bank of Ghana, to give us a brief address to elucidate more on this very important act. Ladies and gentlemen, the Bank of Ghana governor.
Thank you very much for that introduction. I thought that as a guest of honor, I needed to make a few remarks before the panel started. And I thought that I should use the opportunity, in a sense, to give you a context within which this deposit insurance scheme is being introduced. I was not in town last week, but I heard there was quite a bit of a debate on whether we needed deposit insurance in Ghana. And that for me was rather surprising, because I thought it was rather obvious, given the developments that we have seen over the last 10 years, the growth in the number of banks. You've seen banks increase from about 19 banks to about 34 of them. We are seeing banks that are coming from all over with different geographical backgrounds, linkages all over the world. And if you look at the SDI sectors, you will also see the numbers that we are dealing with. Savings and loan societies or corporations, 37 of them. Over 500 microfinance institutions, and 141 rural and community banks. This is how complicated the financial sector is. With a minimum capital requirement of 15 million, you are able to set up a savings and loans company. With 1 million cedis, you get a rural bank. And I think with 2 million cedis, you get a microfinance institution. These firms are all collecting deposits. It's a license to allow the public to put their money into these institutions. I mean, needless to say, this sort of complicated environment would require that the Bank of Ghana should enhance its supervision. We are also seeing banks, for example, that are getting into consolidated arrangements with affiliates in capital markets, insurance firms, banks that are engaged with real estate companies as part of their holding companies. These are all parts of the complications that we see in the financial system. So yes, you can have the most prudent application of banking rules, have the most effective oversight over the financial sector to anchor stability, but then you also need that deposit insurance scheme to provide the added safety net. Again, to provide the additional safety net to boost confidence in the financial sector, especially for small depositors. So the issue is not about the Bank of Ghana or the government admitting that the banks are risky, or if you put your money in a bank, you are undertaking a risky exercise. No. The idea is to have an additional layer of protection in addition to what the central bank normally does in terms of that, providing that oversight over the financial sector. I think this is also a reason why we have had to raise the capital requirements for banks. All things being equal, we expect that with a strong and well-capitalized bank, at least the sector would be well-positioned to offer safer services to customers than in a situation in which the banks had weaker capital. So adequate capital, we think, is also key to ensuring financial stability. So not only are we looking at the issue of deposit insurance, we are also emphasizing on the importance of banks having adequate capital. And then we've also heard about arguments about the new capital requirement and foreign ownership of banks. I think we need to set the record straight, that the data that we have does not suggest that there is foreign dominance in the banking sector. In fact, if you look at the numbers in terms of banks that are domestically controlled and those that are foreign controlled, I think the numbers are just balanced. In terms of the vision for the financial sector, Ghana beyond aid, we want to look at a Ghana that is economically diversified, that can have a financial sector which will assist in structural transformation. And the private sector has a big role to play in that agenda. The financial sector is expected to be well positioned to finance these private sector-led activities. At the Bank of Ghana, we believe that the more benefits will be gained from consolidation. The Ghana Beyond Aid for Financial Sector seeks to achieve bigger, well-capitalized Ghanaian-owned banks, shifting away from small owner, family-managed banks with governance challenges. We think that we will need well-capitalized, domestically owned banks that have effective board oversight with very high corporate governance standards. These are the ingredients for stability and sustainability of the banking sector. Going forward this year, we expect that we would continue to tighten the regulatory standards, ensure that the regulated institutions have adequate levels of capital. We would issue the guidelines to ensure compliance with the minimum capital requirement and address the specific risks from the high non-performing loans, those of the poor corporate governance and the weak risk management systems. In particular, we will strictly enforce the fit and proper guidelines for shareholders, directors, and key management personnel of banks and the SDIs, as well as other supervised non-bank financial institutions. Ladies and gentlemen, this morning is about the deposit insurance. As you're aware, this is a law or a scheme that was established under the Ghana Deposit Protection Act in 2016 to protect the deposits of the small depositors, boost public confidence in the financial system, and reduce the risks of financial crisis. The scheme imposes on banks, as well as the SDIs, the responsibility to contribute towards the cost of resolution, and therefore would reduce the fiscal cost to the government. I hope that we would all enjoy the presentation this morning. Mr. Belnier, who's in charge of the Ghana Deposit Protection Corporation, would make a presentation on the details of the scheme, and then we can have a good discussion after that. Thank you very much.
Can I get a bigger round of applause for the governor, please? Thank you very much, Dr. Nezade Singh. And as he already announced, Mr. Franklin Bellinger, please take your seat here with me, because we're going to start our discussions very shortly. He is the project coordinator, the deposit protection at the Bank of Ghana. They've been working on the act for some time, and he's the best man to join the panel. Our next panelist is a man that I've spoken to many times, very controversial in his thoughts, but cuts to the chase. Ladies and gentlemen, another round of applause. Let's welcome Nana Otoe Champon. He's a banking consultant. Let me also welcome a brief presentation. Nana will want to dive right in once the discussions begin. Right, Nana? Yeah. You want to give us a brief presentation to set the tone? Okay, no, I want you to give us a brief presentation. You want to do that? Yes? Let me invite you to do that. Then I'll give us a brief presentation. And Nana, just set the tone for us, okay? Take your seat, and then that will be the basis for us to interrogate a few of the things.
Good morning. The idea of deposit protection, if you look at the preamble of the law, dates back to the banking crisis, which hit the world over. And then since then, there has been a need. Now, in a way, there has been some mini type of crisis in Ghana, in the sense that some financial institutions have gone down, the latest of which Evans referred to, DKM saga. Now, the aim of the Act is not to protect the pounds, but the pennies, because there's a saying that take care of the pennies and the pounds will look after themselves. So the aim of the Act is for small depositors, not for the big ones. And when we get into the presentation to give the actual figures that back them up, you will see people saying, if I'm only going to get 1,250 if an institution goes down, or 6,250, and I have 1 million, what do I do? Now, since the Act is protecting the small depositors, because those are the ones that we want to come into the system, with term financial inclusion. For the big ones, you get a bit of what you want, but then if the company or the bank goes into liquidation, you can claim in liquidation for the rest. We know that most of the time, when a banking institution goes into liquidation, it means the liabilities exceed the assets. But recently, there was a classic case where the assets exceeded liabilities. That was in the form of Lehman Brothers. And so when it happened, over 10 billion, when they finished the liquidation, was excess of assets over liabilities. They had to go to court to ask the court to give directions as to how to distribute that money. So the deposit protection that we have in Ghana is targeting the small depositors, but there's everything in it for the big depositors as well. So without much ado, Evans, if you can take over and we go on from there.
Sure, and thank you very much for setting that tone for us. And as we begin to interrogate some of the things that our panelists are saying, we begin to understand how pretty simple this all is. We'll welcome our third presentation, finally, from Mrs. Seta Sante. He is a partner, Benchi H.L. Lecturer and Ankoma, and head of financial institutions and capital markets practice group. He will present and join the panel right after his presentation, and then we'll go into the discussion. A round of applause for Mrs. Seta Sante. Mr. Sante has slides, so technical kindly upload the slides for Mr. Sante.
Thank you. Good morning. I think I will ask for my presentation to be uploaded, and then I can proceed. The format has slightly, I was hoping that Mr. Belnio will start, but I will start. I think the Deposit Protection Act seems to have been a very important legislation that has gone under the radar, and not many people have taken a look at it. I think when I was approached by Mr. Yate and his team from Graphic Business to start this, and I started looking at the law in detail, I realized that there was a missed opportunity for most of us who work in the financial services sector to not to have contributed when the law was being discussed in Parliament or sent memoranda. So there are various aspects of the law that we will look at today, which will, I think, over time may have to be considered again. I think most of us here are aware of what deposit insurance is supposed to achieve. So I just want to go through a couple of introductory items and then talk about a few highlights of what the law covers. So the deposit insurance, I think as the governor said, it forms part of a pool of financial safety net mechanisms that is used in the financial system and by government to protect and strengthen the financial system. Now, safety net arrangements are broad, may cover where the central bank provides a lender of last resort provision for banks in trouble. We have sometimes an explicit government guarantee of limited deposits. And also you may have strict prudential supervision as part of a safety net mechanism. Please proceed. Can we go to the next slide, please? Now, deposit insurance may be explicit or implicit. I think you would have, an explicit insurance system is what we have now, where there's a statute that protects specified deposits in the banking system. Implicit insurance is where you have situations where the government is believed to provide protection. Now, you see, this brings a lot of pressure on government. Let's look at DKM, and sometimes actually has political connotations, and government is blamed when there is losses to depositors. So most people would prefer that we have an explicit insurance mechanism which provides transparency and provides, reduces pressure on government, and also provides certainty. Now, when you have a properly designed deposit insurance system, the whole idea is to prevent panic runs on banks and systemic contagion. Now, deposit insurance, however, I think you'll find it in the literature that there's a real danger that deposit insurance can lead to moral hazard in the sense that it increases risk-taking. People think that they are protected, and therefore nobody monitors banks in what banks do. But I think if you look at the details of our act, really it can't lead to moral hazard in the sense of encouraging bank risk-taking because of the fact that it is targeted at small depositors, doesn't really protect large deposits in banks, and therefore those people who have large stakes in banks are still motivated to monitor bank risk-taking. Can you go to the next slide, please? Now, a deposit insurance scheme really is not a panacea for financial stability in the system. I mean, you need to look at it in the context of a whole toolbox of various tools that are available to the central bank. I think the governor mentioned various other options, various other mechanisms, prudential supervision, increased minimum capital requirements, proper corporate governance as some of the means to protect the financial system. Now, if you look at the literature, if you look at all that is written about deposit insurance, you realize that it needs to operate in a system where there is general macroeconomic stability, there's a resilient banking system, and a strong prudential supervision. There's a strong bank resolution framework for troubled banks. And then also that we have a strong accounting and disclosure framework. Now, without these mechanisms, it will fail. I think most people, when we hear about deposit insurance, think that it will solve every problem that we have in the banking system. I think it won't. If you look at even the anecdotal evidence in our economy, you realize that a lot of the danger to the financial system, that will lead to lack of confidence, has happened actually at the very lower end of the market, where people taking deposits who are not allowed to take deposits and leading to losses to the population. Can you go to the next slide? You have, I think the question, I think the governor mentioned the issue of, in the last week, there's been a lot of talk in the newspapers whether we need it or not. I think the evidence is overwhelming about whether we need it or not. I took this data from the International Association of Deposit Insurers. There are currently 126 deposit schemes across the world. There are, as of September 2017, 29 countries are looking at implementing deposit insurance schemes. All these people cannot be wrong. I think it is not that it solves all our problems, but also it is part of the tools in a developing economy to have in the financial system as part of the safety net arrangement. Can we go to the next slide? Now, I just want to touch on certain core deposit insurance principles that we need to take into account when we are reviewing what we have achieved with our Deposit Insurance Protection Act. Now, these principles I just took from the International Association of Deposit Insurers. I just selected a few core principles. Now, there is no one-size-fits-all in deposit insurance implementation, but we need to have certain key matters, and we try to look at these key matters when examining our own legislation. Now, the first one, we need to have a deposit insurance scheme that is operationally independent. Now, I think that's one point that we'll come to when we look at our law. That it should be operationally independent. Now, the independence is very important because it needs to be protected from external interference. It needs to make its own assessment of premiums, its own assessment of what to protect, its own assessment of the examination of banks, for instance. Can we go on, please? Now, the governing boards of deposit insurance schemes should be devoid of conflicts of interest. There's a real danger that where you have people who have interest in the scheme being in control of the governing bodies, then it leads to significant conflicts of interest, which can damage the independence of the scheme. Now, the coverage of the scheme should be clearly defined. It should be ineligible deposits that are not protected should be clearly specified and easily determined. Now, there cannot be anything worse than improper communication of what deposit insurance achieves. And I think most people who hear about deposit insurance, I'm sure if my mother were to be listening to this, would think that any money that she puts in the bank will be protected. Now, that communication of deposit insurance protection should be very clear. Now, let's quickly go through what our Ghana Deposit Protection Act achieves. Now, this act came into force in October 11, 2017. Now, it sets up a DI scheme with a very narrow pay box mandate. A pay box mandate, that means that the scheme is actually only intended to pay out to insured depositors where an insured event occurs. It doesn't take part in any prudential risk minimization and it doesn't take part in bank resolution functions. So it's a very limited pay box function. If you do a comparative study of other jurisdictions, in preparing this for this morning, I looked at Kenya, I looked at Nigeria, Tanzania. All of their schemes have what we call the pay box plus mandate, where the DI scheme has other functions and participates in bank examination and resolution functions as well. Bank resolution, I'm sure most of you would know, would mean the mechanisms for saving and restructuring failing banks. Now, our law, the membership of the scheme are limited to banks and deposit-taking institutions, non-bank deposit-taking institutions. Now, this is mandatory for these entities. Now, the objective is to protect small depositors, and I will talk about small depositors. Small depositors, you would know from the level of protection that is offered. It also is intended to support the development of a safe, sound, efficient, and stable market-based financial system. Next slide, please. Now, the premium for each member, there's an initial premium of 0.1% of the minimum capital of the entity. So 0.1% initial premium when it becomes operationalized. Now, there will be an annual premium which will range from 0.3% to 1.5% of average deposits insured by the scheme. Now, the corporation is also allowed, within 3 years from its operationalization, to start imposing risk-weighted premiums. So the corporation can review a bank's operations and decide that you need to pay a higher premium than other banks. Now, the insured coverage is as you would see, this is where the reality hits you. That is, it's quite limited. So for banks, it's 6,250 cedis. Nana mentioned that. And for specialized deposit-taking institutions, it's 1,250 cedis. Now, the corporation is required by law to review the coverage 3 years from its implementation to determine whether the coverage limit is consistent with economic realities. So that it may be reviewed upwards or possibly downwards. Can we go to the next slide? Now, the deposits that are insurable, I think this is a very important part, and I think this is where we have a lot of confusion when I looked at it with our law. The law protects all deposits up to the limit that we have mentioned, but certain deposits are not covered. And I think what is not covered is not very clear. The first one is an account where the identity of the depositor cannot be identified. That is not covered. An account which is frozen by a court order is not covered. The next one is quite confusing and has potentially far-reaching implications. An account that belongs to a corporate person, a company or any other corporate body, or a member of a corporate person, if the corporate person or its member holds 25% or more of the shares of a bank. So if you take on its face, it looks clear, a corporate person or its member who holds 25% or more of the shares of a bank. Can you go to the next slide, please? Now, if you expand this limitation, what it means is that the bank accounts of a company which holds 25% or more of the shares of a bank is excluded. The second expanded implication is that the bank accounts of a member of a corporate person, that means a shareholder, who holds 25% or more of the shares of a bank are excluded. Now, the third one is that the bank accounts of a company whose member holds 25% or more of the shares of a bank is also excluded. Now, this is quite confusing. So it means that if company A doesn't hold 25% of the shares of a bank, but a shareholder of company A holds 25% or more of the shares of a bank, the accounts of that shareholder and the company itself are excluded from protection. Now, this is not very clear, and the policy objectives behind it is not very clear to me as well. Can you go to the next slide, please? Now, the accounts of an individual who holds 5% or more of the shares of a bank or specialized deposit-taking institution is also excluded. Now, if you go back to the banking act, the root is there. This is a significant interest in the bank, and therefore is excluded. Now, but what is following is actually more interesting, because the family member of an individual with 5% or more of the shares of a bank is also excluded from protection. Now, this is very strange, because the fact that I'm a family member of a person who holds significant interest does not mean that I have any economic relation to that person. Now, the definition of family member is actually quite astonishing, Now, family member is broadly defined in the law to mean a spouse, a child, parent, grandparent, parent's child, brother's child, sister's child, grandchild, parent's brother or sister, parent's brother's child, parent's sister's child. It goes on and on. Now, I think it is very interesting. Now, because you may be excluded from protection without you even knowing, because you have this long relationship. And I think that because of our customary relationships, I think some of these definitions can actually cause a lot of problems to proving who actually is a grandchild, a parent's brother's child. It's confused. I think this should be avoided. If you look at most jurisdictions, this is not included. And I think this is potentially this can lead to a lot of confusion. Can we go to the next slide? Now, accounts belonging to insiders, that's quite obvious. Insiders are excluded. Now, insiders include non-executive directors, executive directors, key management personnel of a bank are excluded from protection. The next one, accounts of persons with related interest in a bank. Now, related interest is defined in the Banking Act, the new Banking Act. It includes persons where, these are persons who have a firm or a company where an insider, a director, a shareholder, a key management personnel have significant interest. All these people are excluded from protection. Can we go to the next slide? Now, it includes holding companies of also companies where related persons have interest. Now, the accounts of audit firms, the audit partner, the audit manager who audited the bank 3 years before the bank went into liquidation are also excluded from protection. They should have known the bank was going, therefore they should have taken it out. Let's go to the next slide, please. I don't know whether that's a good incentive or not, but that's what the law provides. Now, the accounts of pension funds and other institutional investors are excluded. I think it's quite easy to understand this. These are sophisticated investors. They know how to take care of themselves. In fact, the coverage limit of 6,250 Cs is not going to do anything to them, and they are not protected. Deposits held in foreign branches and subsidiaries of local banks are not protected. Foreign currency deposits are not protected. Now, I think this is the area of coverage is an important part, because I think that it is not clear in some of the areas what is covered and what is not covered. And I think that is where, if we are reviewing the law, we need to have a look. Now, let's look at some key challenges. These are matters that I have just a summary of matters that I think are shortfalls that we need to look at critically. The first one is the lack of independence. I think if you look at the whole structure of the scheme, there is a complete lack of independence of the scheme. Now, there is a real danger that the scheme will consider itself as a department of the Bank of Ghana. It shouldn't be. It should be independent. That is what the law intended. Now, the law doesn't say so specifically, but if you look at core principles of deposit insurance, it should be independent. Now, the independence of it is that it should have operational independence. Now, I think that having it structured as if it's a department of the Bank of Ghana is a significant shortcoming, simply because we have a deposit insurance scheme which is protecting depositors. Premiums are contributed by other banks, which premiums may be used to protect other failing banks. The scheme should have the independence to review where the membership of an entity is prejudicial to the scheme, and therefore decide that this company, this bank, should not be a member of this scheme, and we should withdraw the membership. And if that leads to that bank losing its license, that is a problem of the Bank of Ghana. I think the idea of a scheme which is almost looked at as a department of the Bank of Ghana, we need to take a second look at it, because it significantly undermines the efficiency and the effectiveness of the scheme. Can we go on? There was a note that I had. If you look at the Kenyan scheme, the independence of the scheme is specifically provided for in the law, that it is independent and it is not subject to interference from anybody. Now, the lack of examination powers. Now, I started by saying that we have a deposit scheme which is a pay box mandate. It is just simply supposed to pay. It doesn't have examination powers. Now, that I think is a significant shortfall in as well, because if you look at the law, under Section 64E of the law, one of the means by which the scheme may deny membership or may cause a membership of a bank or specialized deposit-taking institution to cease is where the scheme comes to the conclusion that that company, the affairs of the bank or specialized deposit-taking institution, is being conducted in a manner that is detrimental to the interest of that bank or specialized deposit-taking institution, or to the interest of depositors of that bank. Now, I think that is very, very important. If you have the power to make such a determination, then you should have the power to make the examination to reach that conclusion. Now, if you look at the law, under Section 38 of the law, the corporation has to rely on the examination of the Bank of Ghana to reach that conclusion. I think this is wrong. The examination should be done independently. It should have its own independent powers because it is protecting premiums contributed by other banks. It should therefore have its own independent examination powers to make this determination. Now, I have certain questions that is based on this. Now, why does the corporation need the approval of the Bank of Ghana before it reaches a conclusion that a member's affairs are not being conducted in a manner that is in the interest of the scheme or the bank itself? It should reach that conclusion independently. Now, the second one is that because the corporation doesn't have independent powers, how is it able to reach that conclusion that a membership of a bank should cease because that bank is conducting its business in a risky manner? The third one is that if you look at the scheme, the premium structure of the scheme is actually allowed, as I said, within 3 years' time, to start imposing risk-weighted premiums. Now, to impose risk-weighted premiums, you need to conduct independent examination of the banks to determine those premiums. Now, in this case as well, it has to rely on the Bank of Ghana. This is why my concern that this entity may see itself as an adjunct of the Bank of Ghana and a department of the Bank of Ghana. Now, there is no framework for the corporation to be involved in bank resolution mechanisms. Now, bank resolution mechanisms that are set out in the Banking Act, under our new Banking Act, there is significant scope. The Bank of Ghana has significant powers under sections 104 to 123 to save failing banks, to impose several measures on failing banks. But if you look at the law, there is no participation for the deposit insurance scheme. It is only notified when the Bank of Ghana has taken the decision. Now, what is interesting is that if you look at Section 38 of the law, it gives the corporation the power to, when it becomes aware that a company is going to go into resolution, to start negotiations with that company to determine what data is required, who are the depositors, who needs protection. Now, how is it going to know when it is only informed when a decision is taken? I think that even though it is not involved in bank supervision, I think the Bank of Ghana, the law should have allowed a situation where there's a minimum involvement for that entity to participate. Now, can we go to I think this is my last slide. Now, again, this is a point I have made. There's a complete lack of clarity in the scope of excluded deposits. And I think that these are the areas where the law needs to look at again in terms of improvement to make it a better functioning deposit insurance system. Thank you very much.
Thank you very much, Seth. And a bigger round of applause for him. And we are now getting the hang on things as far as this law is concerned. And without much ado, I want to invite a Bank of Ghana rep. He's a project coordinator because we want to get the Bank of Ghana themselves. You know, they've been working on this for a while to try and also narrow down what this is. And because the audience here want to engage, the audience listen to us on radio and monitoring on the social media platform also want to engage with questions. We want to keep this as brief as possible so we can open the discussions to you all to participate and ask all your questions you have. And that's why Seth Belanya will take the stage now and make a brief presentation, sir. Let me invite you. Round of applause for him. He is a project coordinator at the Bank of Ghana. And we have 8 minutes to give us a sense of what they've been working on so far. Thank you, sir.
Good morning to you all. And let me express my appreciation to Graphic Business and Stanbic for the opportunity given us to shed some light on the Ghana Deposit Protection Scheme. I think the order of the presentation was a bit reorganized. We should have done ours first, and then they can do what they want to do. But anyway, I will take opportunity to make a few remarks, and in the process, I will see whether I can respond to some of the issues that is raised. So basically, deposit insurance is about banks and other deposit-taking institutions. We all know that these institutions are involved in financial intermediation. They accept deposits from the public and they grant credit. And because of that, because they hold the bulk of our savings, they're also actively involved in the payment and settlement system. And also because of that, they are agents for the conduct of monetary policy. So banks and deposit institutions occupy a very important position in the financial system. Now, in this process, they assume risks. I mean, you take short-term deposits, you create assets that are medium to long-term, you create mismatches of assets, you can lead to constraints in terms of liquidity, solvency, and all that. And so these risks sometimes the banks are able to manage them, but sometimes they are not able to do that, and it creates problems, and depositors' funds become at risk. Precisely because of this, the authorities, the central bank and government, have put in place what we call a financial safety net. And this safety net is driven by 4 key pillars. The first one is prudential regulation and supervision. You need to ensure that there's a process for entry into the system and exit, and ongoing monitoring of these institutions to ensure that they are operating according to the rules, and therefore they are keeping depositors' funds safe. Now, but sometimes, in spite of prudential regulation and supervision, you can have situations where institutions have liquidity hiccups or they run into solvency challenges. The central bank is there to provide what we call lender of last resort facility. If an institution is solvent but illiquid because the cash flows are not enough to meet its obligations, you can have central bank step in and provide liquidity support. But if it's a situation of solvency, there are not enough assets to liabilities, then you need more than liquidity support. You need to inject capital and all that. And if an institution is not able to manage that process, then it leads to a resolution. So you have to have in place also a framework for resolving banks that are distressed. Now, this is the framework that we have in our country. What we are missing is a 4th pillar, which is the deposit protection. Now, when an institution is illiquid or insolvent, you need to get it out of the system in a very smooth manner. And deposit insurance provides some resources for you to be able to do that without putting pressure unduly on taxpayers, on government, on the central bank. This pillar is very common in all the advanced and all the developed financial systems. And since the global financial crisis, a lot more countries have moved into deposit protection because they found it as a very good anchor to support the resolution framework of banks. Let me quickly talk about the importance of deposit protection. As I said, because banks and deposit institutions hold the bulk of our savings, they are very critical to the performance of the financial system. And so that's why bank deposits are separated and given special protection. If you are engaged in any other business, nobody really bothers that much about it. But if you are involved in the financial system, we need to ensure that you're operating well, that depositors' funds are safe, that you continue to contribute to the wider development of the financial system. The good thing about deposit insurance is that it augments the financial safety net, as I said earlier. It adds on to the 3-pillar framework that I talked about earlier. It helps to boost public confidence because people know that as a small saver, if a bank goes under, my funds are safe. I'll be paid ultimately. So there's no issue about bank runs or people running to the bank because they've had some ill going on there. Again, it helps to supplement government's effort at an implicit system. Without an explicit deposit insurance scheme, what we have is an implicit system in the sense that governments want to ensure that the financial system doesn't collapse. So when there is a distress, when a bank goes under, you usually have to find ways of dealing with that distress, and that puts pressure on government. But with an explicit deposit insurance scheme, you build up a fund that you can use to address those occasional challenges. And because of that, also it helps to reduce the incidence of financial crisis and bank runs. Finally, the key point also is that it imposes some responsibility on the part of the institutions that are involved in deposit taking, in the sense that they contribute towards addressing financial distress. And this then relieves the pressure on central government. My colleague, Mr. Santi, talked about the mandates. There are basically 4 mandates for deposit insurance. The pay box is one. It's very simple. The approach is that when there's an institution goes into distress, the scheme steps in there and reimburses the insured depositors. And then the liquidators are appointed to handle the rest of the liabilities. Now, we also have what we call a pay box plus. In the pay box plus mandate, in addition to reimbursing depositors, you can also use the scheme's funds to support other arrangements like a paycheck assumption transaction, where the funds are just used to help support the transaction. Then we have what we call the loss minimizer mandate, which is a mandate that requires that the insurer engages in a number of range of solutions. They look at the least cost of the solution to the entire finance system, and then they take that option. And finally, we have what we call the risk minimizer. In the risk minimizer mandate, that's the broadest of the mandates. Here, in addition to reimbursing depositors, you can also get involved in regulation and supervision of the financial system. You take on more responsibility. You work together with the central bank in supervising the system, ensuring that the risks the banks are taking are reasonable and are manageable. So that is the broadest of the mandates. But we have opted for the most basic mandate because we want to learn along the line and build capacity before we are able to jump into the sea. There's been debate about whether deposit protection is right for Ghana, whether we need it or not. So I need to give some bit of history to that. It's not a new concept, really. If you look back, the U.S. set up this in 1933. Since then, in Europe, in the 1920s, Czech Republic was one of the countries that set it up. Then Germany in 76, Britain in 79, France in 1980. The European Union took a decision to make deposit insurance a requirement for all states in 1986. And India, Sri Lanka, and other countries have since moved on. Even in Africa, Kenya established their scheme in 1985, Nigeria in 1988, Zimbabwe in 2003. During the last IID conference in Canada, it came out that even the Francophone bloc next to us have started a deposit protection scheme. And so what we are doing is not out of place. And the other point to note is that since the global financial crisis, a lot more countries have put in place deposit insurance schemes because they see it as a fourth pillar that can support the three pillars in ensuring a safe financial system. In Ghana, we still have a large number of small, unsophisticated depositors who need protection. We need to continue to promote financial inclusion